game waves in the index annuity arena. We're so excited about their platform. And I am Julie Stewart, the Annuity Director here at the Milner Group, and we are joined today by David Wood, who's the Regional Sales Director for Lincoln Financial Group, and Warren Yancey is also on the line, who is the Director of Marketing. Today, David's going to discuss Lincoln's OptiBlend product, and this is just one of many stellar options on their platform. He's going to discuss how it's positioned for strong accumulation and growth, and I will say this, as of December 1st, their rates have gone up, so Lincoln is really making a statement that they're here to stay, and these are really what's known as a performance-based index annuity, offering your clients just a strong opportunity to capture that upside growth potential. And an interesting fact, and what we feel is a game changer, is that Lincoln offers an income rider that can be added after the contract is already in force. And this just opens up a world of possibilities for your client. Lincoln is the first carrier to come to market with an income rider that can be added after inception. And we're just really, really excited about that. So without further delay, David, take it away.
Perfect. Thank you so much. Thank you, everyone, for taking the time to be on this call today. We are very excited about, obviously, this new product that we launched in June, not only for accumulation but for income. It's called Lincoln OptiBlend, and just kind of want to give you a little background on it. We've seen what we call these hybrid indices, or the volatility accounts, however you want to say them, really start picking up sales. Before last year, you didn't see much of them. Obviously, you'll see from this chart, first quarter they weren't around much. Then they came around in the second, third, and fourth quarter. We expect those sales to be much, much higher this year in 2015. And the reason really that they came around was that people were looking for ways to get higher returns in this low interest rate environment. So since 2008 and the market declines, clients have been looking for safety of principal, that protection against a downturn. That's what index annuities have always had. Now the problem with that is that rates went down, right? We've been in a historically low interest rate environment. We've seen rates capped at 3 or 4%. And so that's really made the carriers look for ways to give the clients higher returns compared to just your traditional caps. So when we designed this product, we wanted to design it in mind with giving the client flexibility, giving them the options, multiple options, obviously have the downside protection, and then bring in a new strategy to give them more upside potential if the market performs. So we launched with a 7 or a 10-year product, 4 accounts in there, all annual accounts. So it's an annual fixed account. You have the 1-year risk control, which is our volatility index or hybrid index. You have an annual point-to-point and an annual performance-triggered account. Like I said, a 7 or 10-year option. A lot of carriers play in the 10-year space, not as many carriers in the 7-year space. Julie alluded to it earlier, but we do have the income rider, and we're the only carrier that allows that income rider post-issue. So not only does the client have the ability to add the income rider day one, but they can add it any time on the anniversary date, contractually guaranteed. So this really does give the client the best of both worlds. Do they want this product for income, or do they want it for accumulation? And like we all know, people change their mind. So if they change their mind down the road, they can add that rider later on. Commission options, multiple options on this. Milner will have those all for you, but we do have trail options on this as well, so not just your standard up front. The volatility strategy we went with is called the S&P Daily Risk Control Index. We'll dig down into that a little more, a couple slides. But basically what that index does is it's an index just like the S&P, the traditional S&P, or the Dow, or the Hang Seng, or any of the other indexes out there, indices out there. But what it has is a volatility component on it. And effectively what that volatility component does is that if the market gets too volatile, then it goes to cash for that day. Sometimes volatility is a good thing, and it means the market's going up. Sometimes volatility is a bad thing, and it means the market's going down. And I'll show you some examples of how that works. like I said, in a couple slides from now. But that is a trackable index. Lincoln's hands are not in it. It was around before this product, so it's not controlling or manipulating. We're tracking that just as we would track the Dow or the S&P or anything else. So here's, just kind of a breakdown of the 4 accounts. We like to call them buckets. There's no investment restrictions between these 4 accounts. You can put as much money into each bucket as you want, and you can move those monies or move those funds on an annual basis. So you're not locked in. There's no investment restrictions. Change your allocations every single year if the client would like. So you can definitely move in between those 4 accounts. It is also a flexible premium product, no rolling surrenders. So what I mean by that is a 7 or a 10-year product. If you make a deposit in year 4, year 5, it's still fully liquid after 7 years or after 10 years. So flexible premium as well. So there's ways to add money to the account. And again, you have those 4 options to choose from. Lots of information on this product. We have the standard, client guide, brochure, fact sheets, but we also have a ton of marketing material on this. Marketing material on that new strategy, marketing material on the product. So there's a lot of stuff that is client approved. So if you're looking for any of that material, whether it's just to have it to hand out during a sales meeting, or if you're looking for some material to send out to clients, whether it's a mailer or whether it's an HTML, contact Milner Group and they can help you out with that. We have all that information and we can co-brand with your information on that as well. Very important. Make sure if you're in an NAIC state and you're writing this product that you've taken the product training before you write the product. If not, you're going to have to go back to the client. So if you're in the NAIC state, just make sure you've taken the training. So here's the slide that I really want to spend the most time on. I'm going to give everyone a little credit on this call and assume that most people are familiar with indexed annuities. So I'm not going to spend a lot of time talking about the fixed account, or an annual point-to-point, or performance trigger, right? So the fixed account, just your rate. The annual point-to-point, you get anything up to that cap, nothing higher. The performance triggered account, as long as the market's flat or positive, that number credits. The new strategy is a little different. So the way that strategy works is you follow the S&P Daily Risk Control Index. You're going to do whatever that index does minus a spread. So for example, we're going to assume that the spread is 2%. So this is a hypothetical illustration below. Don't worry about the allocated interest. The way they did this one, they divided money between all the accounts. We're going to assume for a second that you went 100% into just that S&P Daily Risk Control Index. So you put 100,000 in or 250 in this illustration. You went all into that S&P Daily Risk Control Index, and we're going to assume that the current spread is 2%. So what we're showing here in year 1 is that the S&P did 35%. Now look, we're still in index annuity, right? It's going to be more conservative than the market. So don't expect to do what the S&P does, right? If the client wants the S&P, they can go out and buy the S&P. This account is to give the client more upside potential than a traditional cap of 4 and 5%. So the S&P 500 did 35. This account did 24.88. Take off the 2% spread. The client would have been credited, assuming they went 100%, 22.88. So that 24.88 minus the spread, that's what goes to the client, assuming they went 100%. The next year, S&P did 18. This account did 11.34. Again, 11.34 minus the 2% spread, the client would have gotten 9.34% credited. So here's the question. Is 22.88 or 9.34 higher than a 4 or 5% cap? Of course it is. So this is showing you that this account has that potential. Let's look at a couple other things. Go down to year 7. the S&P 500 was negative 11%. But this account actually credited positive. Now, if the spread was 2, it just would have zeroed out. But if the spread was less than 2, let's say it was 1 or 0.9, the client would have actually gotten credit when the S&P was negative. And remember what I told you earlier, that this account, we're tracking it, right? Your money's not in the account, just like when we track the S&P or the Dow. Your money's not in it. We're just tracking that performance. And that account goes to cash when it gets too volatile. Sometimes volatility is positive, like the first year of 35%. But sometimes volatility is negative, like the negative 11. So pluses and minuses to that volatility, but you'll see in year 7, it credited positive when the S&P was actually negative. Again, there's 0 floor on this. So if it was a negative 1 or a negative 4, it just would have zeroed out, and the client would not have lost a single dollar, and they would just gotten 0 for that year. If you look at those years, again, don't think about this account as doubling or tripling your money. Think about this account as being the cap. And that's what we're looking to do and still have that downside protection. A lot of carriers out there have products similar to this. We'd like that to be known. We call them Generation 1s and Generation 2s. Generation 1 were the first ones to come out. Generation 2 are going to be more like what Lincoln has, a lot more transparent, following indexes. I'll tell you right now, and here's the thing to know, is that Lincoln has the lowest spread on an annual account. A lot of people have come out with 2-year and 3-year accounts. We went annual. We have the lowest spreads, and I'll show you the spreads at the end. We're tracking an index with history, actual performance. Lincoln's hands are not in it. We have a 7 and a 10-year option. So that 7-year option gives the clients the ability, obviously, for a shorter surrender, but also has the ability to write clients up to age 85. With a 10-year, you can only write to age 80. Our income rider not only is very competitive on the payouts, but we can add it post-issue like we talked about, which we're the only carrier in the industry to allow post-issue. So jumping through some of this, let's talk about the income rider. Lincoln designed our income rider very different than a lot of the competition out there. Obviously, paycheck or the payout amount is very important. But what we realized is there's a better way to have a good payout or a competitive payout, but to give the client some better benefits. So what we did is, instead of having a high roll-up like a lot of carriers out there, you'll see 6s and 7s and 8s, we went with a 5% compounded roll-up. Very important, and we'll touch on that in a minute. But we did a 5% compounded roll-up, so to make up for having a lower roll-up, we have higher payout factors on the back end. Our payout factors are age-banded, but we also give the client a bonus for deferring income 5 or 10 years, and I'll show you that in a minute. And then we have a nursing home enhancement. If the client goes into a nursing home, as long as they're 65 or older, they've had the rider for 5 years, that payment, whatever it is, 4%, 5%, 6%, whatever it is, will jump up to 10%. So let me show you an example. A 60-year-old that takes income immediately, 4.5%. So on $100,000, they would get $4,500 a year. That same 60-year-old, if they wait to age 65, they've now hit a new age band. Instead of 5% payout, which is how much you get paid out at 65, we give a 75 bips bonus for deferring income 5 years. So if they bought it at 60 and wait to 65 to turn it on, they'll get a 5.75% payout. That same 60-year-old waits to age 70. Instead of getting the 5.5% payout, they get a 6.75% payout. And that's because if they defer income for 10 years, we give them 1.25 bonus. So you get whatever your age band is, 60, 4.5, 65, 5, 70, 5.5. plus you get a bonus if you had deferred income for 5 or 10 years, 75 bips or 125 bips. So very, very competitive payout factors, which that along with the 5% compounded roll-up give us those very competitive payout or paychecks to the client. You'll see the gray shaded boxes. That's that 10% nursing home enhancement if the client goes into the nursing home. Again, they have to be at least age 65 and held the rider for 5 years. So going back to what I said just a second ago, why did we go with a 5% compounded roll-up instead of 6 or 7 or 8 or 9 or 10 or whatever? And the reason being is we wanted to give the client a very competitive paycheck, but we still wanted to give them the ability to outperform that guarantee. We do what's called a high water mark. Every single year, we look at your account value or we look at your income base. So your income base in year one would be 100, after year one would be 100,000 in this example, plus 5%. So it would be 105. That will be your new locked-in amount, or if your account value outperforms, we'll take that account value and put it over and lock that in as your income base and start rolling up off of that number. What's easier to outperform, 5 or 7? 5, of course, right? So the question is, can you outperform 5 with a 3 or 4% cap? Of course not. But let's go back to that illustration. Can you outperform a 5% roll-up if you're credited 24.88 minus 2, so 22.88? Of course. 11.34 minus 2, 9.34? Definitely. 13.38 minus 2, 11.38? Definitely. So that roll-up and payout factor gives that client a guarantee, and that guarantee will stack up against any single carrier out there in the marketplace. But what we have on top of that guarantee is the ability to outperform if the market performs. And this account, the way it works, gives that client the ability to outperform that guaranteed income. So again, think about this product for accumulation, think about this product for income, but also think about it as the flexibility of both, because you can add that rider post-issue. The rider, obviously Milner or Lincoln can run those illustrations for you, or you can run them yourself on our website. But that income rider, obviously use the illustrations to get the numbers, but simply it works 5% compounded roll-up, and your payout is based on your age that you turn on income and how long you've held the rider. Now, what I want to show you is what our actual rates are. So we talked about a 2% spread. Here are our rates for December. If you look on that 10-year product, we have a fixed account, now this is for 100,000 or more, a fixed account of 2.5. The spread, instead of being 2%, is actually only 0.9. So you remember that year that it credited like 1.09? That would have actually been 19 bips going to the client versus a negative 11% plus return from the S&P. That performance triggered account, 4.25. So the way that works, as long as the S&P is flat or positive, they get 4.25 on any money into that bucket. So the S&P does 0, they get 4.25. S&P does 2, they get 4.25. S&P does 10, they get 4.25. And then we have a 1-year point-to-point cap at 4.75%. Again, that's a cap. They get anything up to the cap, nothing higher. So almost like a ceiling in your house. 7-year product, still very competitive, 2.25, 1.4 on the spread, 3.8 on the triggered, and 4.2. So very, very competitive rates right now. Obviously, you have the 4 accounts, no investment restrictions. Allocate all into the new index, do 25% into each. Completely, that's up to you and the client how you want to allocate these. But all annual accounts. So those accounts will reset. And one of the things that Lincoln does, and one of the things that Jefferson Pilot does, and one of the things that we pride ourselves on, is that we actually publish our renewal rate history on every single one of our products, and we can show you what every single product has done, how the rates started, how they reset, and how that product performed. So we think that having the annual resets is a great thing, especially if we see some interest rate movement over the next year or two. We would expect that if those interest rates go up, that this product will reset with higher rates over that period. So again, thank you for your time. I'm going to turn it back to Milner. But again,
Awesome.
thank you for taking your time today.
Yeah, David, you made some really great points. You know, really I think it's important to understand, like David was saying, that Lincoln is using a volatility control based on an index that has a ton of history, and really where that is important is because we're seeing a lot of other annuity carriers come to market with indices that are brand new. They've designed them with third-party companies. There is no real historical. I mean, they can quote-unquote back test them, but it's, you know, it's not real. And it's hard to draw that line when you're saying, hey, this is uncapped potential, you know, operating on a fee or a spread. And here, Lincoln is, you know, the S&P is a tried and true. Everybody is familiar with it. It has long-standing history, and it does perform. And as you can see, their rates are incredibly competitive. I mean, just looking at the 10-year, you know, with less than 1% spread on a 1 year, it really is just astounding. And there's ways within this product to hedge for different interest rate environments. You know, the performance trigger, we have a lot of advisors who love to use that as a hedging mechanism for, you know, periods of volatility where their clients may be feeling a little bit more conservative and they're not real sure, but they want to know that they're going to get something, so they'll put money into that bucket, sometimes up to 50% in any given year, and then reassess at the end of the year because they know if the market is flat or if there's even a fraction of a percent of a movement, your client's going to get that stated amount. So again, on the 10-year example, if he put 50% of his money into that bucket and it moves a fraction of a hair in a positive motion, your client's going to get 4.25%. So I think, you know, and at the Milner Group, we can help you understand the different ways in which you can allocate your clients' premiums, you know, based on what their risk tolerance is and how to reassess that each year. In addition, you know, with the 5% compound roll-up, you know, again, coupled with an uncapped opportunity, and again, I'm talking about that 1-year volatility control operating off of a spread, it really does give your client just an enormous opportunity to outperform that 5%, and really it's going to outperform that 7%, 8%, 9% roll-up that we're seeing out in the marketplace because of that uncapped opportunity and low spread. So, you know, as a whole, we do feel that it is extremely competitive, and, you know, again, just knowing that your client, as we know, people's financial situations change typically every 5 years, so what they buy today might not necessarily be what they need tomorrow, and this product is offering your clients flexibility and peace of mind to know that if their situation should change, they can put that income rider on there. We know the income rider is competitive, it's contractually guaranteed, and you know, you're the hero because you've been able to make sure that they can get the best of both worlds. So with that, this webinar will be recorded. If anybody would like to see some illustrations or talk further about this product, please do not hesitate to reach out to me. I can be reached at 800-926-9206. And outside of that, we hope you all have a very successful day.